While the Labor Party have indicated that if they come into power, they intend to introduce a number of new taxes which are directly going to affect our property markets, the 2019 Liberal federal budget made little mention of property. However, there was plenty of good news in the budget, and many key initiatives are likely to help promote economic growth, and they're going to be positive for our property markets. Now, while the economic fundamentals are generally sound, I found that home buyers and property investors are currently suffering from a crisis of confidence, and our housing markets are unlikely to rebound until consumers feel more confident about their job security, about our political stability, about the certainty of tax treatment if they're property investors, and until the media stops scaremongering us with stories of a 40% crash in house prices. In my mind, fortunately, there was plenty in the budget to boost consumer confidence. There's proposed tax cuts, there's giveaways, and these are going to add to household disposable income. And our economy is back on track to get a surplus, and these measures are going to allow the government to give some business incentives, to create some jobs, to hire more people, take on more apprentices. So what does the budget mean for property? So that's the topic of my discussion today, our regular weekly Property Insider chat with Dr. Andrew Wilson, Australia's leading property economist. Good morning, Andrew.
Good morning, Michael. Yes, happy budget day to you.
Well, I know you were up really late last night looking at all this, so I look forward to examining it, getting your views, seeing how it's going to affect our market. And at the end, I'm going to ask you a question. I'm going to ask you, will the budget be enough to get the Morrison government re-elected? But not yet. Don't answer yet. Let's leave our viewers and listeners in suspense for about 20 minutes. So in short, Andrew, what was your view of the budget? And then we're going to work through it.
Well, certainly it was reasonably predictable, Michael. We flagged that we get tax cuts and some giveaways. We know that the budget is moved back into surplus. Not yet, though. It's not this year. Where the budget.
No, that was a surprise, wasn't it? Everyone thought there was going to be a surplus. Well, that's what they were hinting.
Well, back in black next year. And of course, we may have a different government next year. So we have to take all the forward projections with a grain of salt. Of course, the tax cuts will be passed by the current government in the parliament. And, you know, it's still really a leap of faith to some degree how our economy will pan out over the next couple of years. As usual, the optimists outweighed the pessimists in terms of the Treasury forecasts. I do think they're a little optimistic. But having said that, of course, it is better to be moving into a surplus. We do have a hefty debt to pay off to fund our deficits. So that will move now out of the accounting book and will be a positive for the balance sheet going forward. But certainly a predictable budget, tax cuts, some giveaways, big infrastructure spending. And I do believe that the Treasurer in his budget speech announced the word or said the word tax increases some many dozens of times. So I think we've set the scene for what the election, which is obviously soon to be called, will be based on. And that'll be higher taxes from one end of the spectrum and lower taxes from the other.
We'll work through each of those in turn. So the budget gave us a tax cut, actually for most of us. Now, I know good economics doesn't always make good politics, and good politics, like tax cuts that they're doing, doesn't make good economics necessarily. So what's your view on these tax cuts, Andrew?
Well, the tax cuts to a certain degree, Michael, make up for the loss of incomes growth. So roughly about a % increase to disposable incomes will come from those tax cuts, which are around about $1,000 per individual, $2,000 per couple on average income. So look, makes up a little bit for that loss of income growth that we've been suffering really for a number of years now, and which has worked its way into reduced consumption. But we've got to remember that latest stats are showing us that taxes are rising faster than incomes. So it'll be, certainly a positive, but not enough to, I believe, stimulate consumption to the sorts of levels where we will see incomes growth getting back to what we saw in previous cycles.
Now, there's lots to talk about in this budget, but we're going to confine it to property. The reason I
Yes.
think you talk about income growth is because
Yes.
now with lower interest rates, the norm, what's going to allow people to spend more on property? And it's going to be more disposable income, and therefore income growth is important.
Well, look, I'm not sure that the actual level of incomes growth is going to make a big difference to consumption, Michael.
I agree.
I think that there are 2 points to come out of the budget, I think, in terms of house prices and the housing market. The first is, of course, it's a positive to have more money in your pocket. I think that will add to stabilise what's, certainly low levels of confidence at the moment in housing markets. We are starting to see perhaps some early signs of that confidence now starting to lift. But other than a fillip for confidence, the budget, I think, reinforces that we will have a low and likely lower interest rates for longer now, given that the projections for incomes growth, for GDP, are certainly well down on what we would need to start to see any sense of higher interest rates and inflationary breakouts that we've seen previously. This is now a very long grind of low incomes, a low inflation, and that'll mean low consumption continuing, low economic growth, particularly as it's generated from consumption, and that will mean certainly no prospect of higher interest rates in the outlook, and certainly growing prospects of an interest rate cut, as the Reserve Bank did indicate yesterday.
Sure. In this April's meeting, the Reserve Bank, it changed its narrative, didn't it, on interest rates? It now said it's prepared to support the economy if it's required. And I don't know, my reading of that is, hey, we're prepared to drop interest rates. It's changed 180 degrees.
Well, it has. That's been a long and rocky road to Damascus for the Reserve Bank. It's come later than it should have, but of course they have to be wary of the big picture and they have to really examine the historical evidence for monetary policy. But there's no doubt that we've seen this moribund economy, particularly in terms of consumption and incomes growth now for a number of years. And perhaps the Reserve Bank got a little bit too carried away with the Sydney housing market and resisted what was a logical continuance of lower interest rates. I think it was only the better jobs data that we got for February that kept perhaps the Reserve Bank on the sidelines. So if we do start to see some issues with the unemployment rate, I think the Reserve Bank will be quick to act and cut interest rates.
Okay. Now, I also see the significant infrastructure investment in the budget as helping underpin our economic growth, but not just in our big cities, in regional Australia, because new jobs are going to be created. And I like it when the government spends on infrastructure because in general it uses local resources rather than overseas resources. It uses local jobs, but it also leaves a legacy for the future. The tunnels, the railway lines, the crossings, the highways, all that's going to be useful for future generations. Andrew?
Well, yes, that's true, Michael. But in terms of housing market dynamics, it really is a very long view of its influence. And, we've had a good infrastructure spend now for a number of years, but it hasn't stopped the housing market and house prices sharply declining over the last 6 months. In particular, short-term dynamics is what fuels the housing market and house prices. It is good in terms of establishing, as you said, high levels of infrastructure, particularly in regional areas, and it helps to make our cities particularly more efficient in terms of congestion, and it helps create a better living environment, particularly in inner suburban areas. But in terms of the housing market, really it's a non-issue in my opinion. These things happen down the track. It's other factors such as the prospects for the macroeconomy and local demand and supply issues as they're being generated in real time that have the most influence on our housing market.
Andrew, I agree with you. When I said infrastructure is going to be useful, I think it's great for our economy and it's great for jobs. But I also agree that we don't chase infrastructure to look for the next property hotspot because it could be so far off and it doesn't necessarily lead to higher property values. The other thing that I found interesting in the budget was reducing migration by about 20,000 people a year to 160,000 per annum. But Andrew, isn't that just taking it to where it is today?
Look, that's right, Michael. But I do think that this is as you mentioned, perhaps budgets aren't good for good for politics, but not good for economics. I think that we've got our tax cuts and our budget surplus on the back of very strong jobs growth, which has created strong income or tax income revenue for the government. And of course, most of that has come from migration, high levels of net migration over the last 2 or 3 years. In fact, even though our latest GDP numbers weren't that flash, 0.2% over the December quarter, if we take out the influence of migration on that GDP, we actually would have gone backwards over the December quarter. So playing to the crowd to some degree, reducing migration. Numbers are still good. That'll still help to stimulate the housing market going forward. But it really is a trade-off between, the issues of higher levels of migration, issues about can we support higher levels of migration, and the clear offset to that is that it generates economic growth, it generates a better budget, and it generates the prospect of more demand for housing.
Interestingly, good point at the end there, because the migrants we're getting to Australia are coming because they've got skills for jobs, and they're in general in household formation age rather than the older migrants or the young kids. And for that reason, that'll be positive for housing. Now, the economic forecasts in the budget, Andrew, the figures seem underwhelming to me.
Look, they are, Michael, and this is the issue that, we don't have, the unemployment rate's predicted to remain around 5%. Now, remaining around 5% is where we've sort of been for the last year, and it hasn't done too much to get jobs off the ground. And Treasury forecasts 2.75% growth in GDP next year. We really need a 3 in front of that at least to start to generate the type of, economic activity that will create competition for labour and push up wages. And really at 2.75, which I do believe is optimistic, given that we had just that 0.2% rise over the December quarter. We've had 3 quarters of falling GDP growth, low and falling GDP growth. I'm not sure we'll be able to manage 2.75, but even if we do, I don't think it's anywhere near strong enough for us to generate the incomes growth that we need to put money back in people's pockets, to get them spending again, and to get this economy back to looking like what it used to look like with rising inflation, rising prices and rising prosperity. And the forecast for incomes growth, again at 2.75% next year, Michael, considering it's at 2.3% now, and it's had a bit of a jump in recent quarters, it's still very low and well below, again, those 3% plus levels that we need to generate prosperity. And I do think that's an optimistic forecast at 2.75% next year growth for incomes.
So we've discussed lots of things, Andrew, but to summarise it, can you just give us the bottom line and a summary of your thoughts?
It's a good budget for the housing market, Michael. It's going to help to stabilise confidence by putting more money in people's pockets. It's not a bonanza, but it's more money in an environment where household budgets are constrained. But the clear message out of it is there's nothing's going to change in terms of the economy. And that means that interest rates will remain lower for longer with the chance of a cut. And that is always positive news for the housing market. What it does is it takes a lot of those external drivers off the table. And it does mean that local factors, as usual, will predominate how house prices react. And of course, that's, more of a positive in terms of predictability for housing markets. But, as I said, I think it's a positive budget for the housing market and for house prices. But don't get too excited here. Growth in the longer term will reflect low economic and interest rates, economic growth and interest rates, and will be quite low by historical standards, but more predictable going forward. So I just thank the Lord, in a sense, Michael, that the government has opted not to get involved in housing market policies, as they did, in my opinion, disastrously 2 years ago, when they certainly introduced policies along with financial regulators that have acted to create this sharp decline in housing market activity that we're trying to get out of at the moment.
I think it's always worth remembering that there isn't a housing market. So I'm asking you slightly unfair questions because different segments of the market are going to perform differently. Certain sectors are going to do well. Certain demographics are going to earn more income than others, and they're the ones that are going to be able to afford to upgrade their homes, buy investment properties. But now, Andrew, to the big question.
Big question.
Budget enough to swing sentiment around and have the Morrison government re-elected? Because we know that if Labor comes into power, they say there's going to be a mini budget in a couple of months' time, and all this goes out the door.
Well, I don't believe in a mini budget, Michael. There's no cover for that. The usual cover for that is, uncovering a debt bomb somewhere. But the budget's in reasonable shape now. I don't think the Labor Party would want to rock the boat with any scary stuff. They don't need to do that going forward. We will move into a much better budgetary position. But let's look to history in terms of answering your question, Michael. The last time we had a budget surplus was in 2007, 2008, 2006, 2007. And of course, we had a tremendous mining boom at that period. We had very strong incomes growth and we had strong house price growth. It really was a bonanza for everybody in that particular budget, but it wasn't enough to save the Howard government, Michael. And I'm not sure that what we've been offered yesterday in this budget, which is certainly well below the standards of John Howard in 2006 and 2007, will be enough to save this government going forward.
Well, we're going to be speaking regularly and we're going to follow how that's going to affect our housing markets. But maybe the bottom line is be prepared for a raft of tax changes that could in the future be negative for our property markets. So Dr. Andrew Wilson, Chief Economist of My Housing Markets, thank you so much. Look forward to our chat again next week.
Thank you.